deferral option for Pakistan. So more likely we will be going towards a deferral option, and there may be some notification when IFRS 17 is adopted about the deferral option which has been taken for IFRS 9 application as well. So by and large, I think we will be implementing IFRS 9 together with IFRS 17. Now, before we look at IFRS 9, I think let's take a conceptual view of what are the key considerations that the insurance companies take into account while they think about the evaluation and measurement basis for their investment portfolios. Now, many of the insurers and people who work day in, day out in insurance companies know that effectively the insurance companies wants to match the cash outflows on one hand that they have from the insurance contracts, from the cash inflows that they can have from the investments that they hold, and also from the new policies that they write. So this matching of cash flows is very, very important, and therefore the valuation on the balance sheet on one side of the liabilities of the insurance contract liabilities, and the valuation on the other side in terms of the investments that are held to support those contracts should also match. So if you apply a different measurement basis for insurance contract liabilities and apply a different, for example, if you have long-term insurance contracts in terms of life products, which are measured using the current values on the basis of the current discount rates, on the basis of the fair value methodology. And on the other hand, you have investments which support those liabilities are measured at amortized cost. You will have, and you will end up in a P&L conflict, because the impact of the liability remeasurement will go into the P&L account, whereas the impact of the investments will not be there, because those investments are carried at cost. Or if those investments are carried at fair value through the comprehensive income account, then the matching impact will be in the equity rather than the P&L account. So the accounting mismatch has to be avoided, and that is the main conceptual framework which is applied while deciding on the measurement basis of the investments that are held by the insurance companies. Now, IFRS 17 requires that all the insurance contracts should be fair valued in terms of their expected cash flows, the risk factors that they have, and also the discounting element. And therefore, by and large, predominantly, the impact goes into the P&L account. So if you look at the insurance contracts that we have, by and large, we have long-term contracts issued by the life insurance companies, which are investment-linked, unit-linked, and therefore they are measured at fair value. Also, some of the insurance companies also issues long-term annuity contracts where actually you have fixed cash flows over a long period of time. For those insurance contracts, for the investments held to support those insurance contracts, the best methodology in terms of the valuation is a fair value through P&L account in order to achieve the accounting match, because you want to have the fair value gains or losses into the P&L account to match the fair value gains and losses that you have on the underlying insurance contracts. The other side of the contracts, like for general insurance companies, which are simpler contracts, short-term contracts, which do not have much of an impact because of the investment values, because of the market factors. For the investments which are held to support those contracts can be measured, those investments can be measured either at amortized cost or fair value through P&L, through comprehensive income approach, if the insurance companies want to avoid a lot of volatility into the P&L. Because you do not have to really match the fair value gains and losses on the liability side with the asset side. So then the choice is more driven by whether you want a volatility from the fair value changes in the investments in the P&L account or not. If you don't want those volatilities, then you predominantly will decide to have investments at amortized cost or fair value through comprehensive income. Whereas if you want to be aggressive and you want to take all the volatility in the P&L account over a longer period of time, whether it's gain or losses, you might choose for fair value through P&L option, in which case, which is a one-time choice. It's not reversible. It's not an option which can change depending on the direction in which the market is going. So once you choose an option to fair value all the investments through P&L account, this is a one-way traffic. So you cannot change on that option. So this is dangerous in a way, and therefore you will see more and more insurance companies are inclined to choose options when it comes to the general insurance liabilities and businesses and the investments which are supporting their shareholders' equity, to go for available for sale kind of a model where investments gains goes to the equity rather than to the P&L account, and also in some cases the investments are held on amortized cost basis. So this is kind of a fundamental, overview of what is a business model and what is the thought process when we look at the investments portfolios and their measurement basis in the insurance companies. Currently, I think 2002 regulations, which are still being followed by many of the insurance companies, all the life insurance companies are required to hold their investments at lower of cost and market value, unless those investments are held to support the investment linked business, in which certainly those investments are fair value to match with the related liabilities. Also, for non-life insurance, by and large, we are following a lower of cost and market approach. No investment is fair valued. Whereas under the new regulations that we have in 2017, many of the insurance companies are yet to apply those regulations, are actually compliant with the IFRS requirements. So they refer to the IFRS for the investment accounting, which means that the insurance companies have to come out of the regime of lower of cost and market value to a regime where the investments are required to be fair valued as per the IFRS framework. Now, IFRS also provides a classification choice when it comes to equity or debt investments, and available for sale category, even if it's chosen under the IFRS, it requires fair value measurement of all the equity portfolios and also the debt portfolios, but the gain and losses will go to not to the P&L account but to the comprehensive income. So as the insurance companies will adopt the new regulations, if 2017 regulations, then certainly the balance sheets will take the impact of the fair valuation and mark-to-market impact on one hand on the asset side and the other hand on the equity side. But they will not hit the P&L, because in most of the cases, the insurance companies are not holding trading portfolios. They're not actively trading. They're not at least declaring that they are holding trading portfolios. So all the portfolios are classified as AFS, and therefore typically the gain and losses and mark-to-market gain and losses will not hurt or impact the P&L account. So that is the change which regardless of IFRS 17 or IFRS 9 is already on the cards, and which will start showing its impact from 2018 year. So if you take that scenario and then think about IFRS 9, so IFRS 9 model depends on whether the investment is an equity investment or a debt investment. So there is a slightly different model of accounting for equity investments and debt instruments. So let's look first to the equity instruments. So equity instruments are divided into two categories. The first category is investments which are held for trading purposes, and the investments which are held for non-trading purposes. So by and large, the equity portfolios, if are held for trading purposes, are still, as currently, are required to be fair valued through P&L account. So there is no debate on that. If you have a trading portfolio where there is a short-term active trading, there is a pattern of trading, frequent buying and selling, then those trading portfolios have to be fair valued through P&L account. And if you have a non-trading portfolio, which most of the insurance companies believe that they have non-trading portfolios, which are held for long-term dividend returns or long-term or medium-term capital appreciations, then or to meet the liquidity needs if there is any for their liabilities, then those portfolios which are non-trading actually can be either fair valued through P&L, a choice that can be taken at the very inception, at the date of purchase of the investment, and it's an irrevocable choice. If that choice is not taken, then those investments are treated like fair value through changes taken to the comprehensive income or equity, not to the P&L account. More or less like AFS accounting model, but it's not entirely AFS accounting model. I tell you why. Because the change is that if you have a non-trading investment portfolio and you've chosen to carry it through comprehensive income, currently what happens is when you sell the related investment which is held in the AFS portfolio and you realize the gain or loss, you actually transfer the gain and loss from the comprehensive income to the P&L account. But that is not going to happen under the IFRS 9 model, because it says the gain or losses on the non-trading portfolio which are held to fair value through comprehensive income or OCI, it will permanently reside in the OCI, or it will permanently remain in equity even in situations when the investments are disposed or impaired. So what will happen is that the AFS investments gains which actually now reside in the equity will remain in equity even if you dispose of those investments, even you impair those investments, but this is a permanent destination of those gains and losses as regards as the company is concerned. So therefore, there is no P&L kind of impact arising from the investment portfolio or non-investment portfolios, which is a kind of big change, because capital gains is a very, very important part of the P&L of many of the insurance companies, and the timing of recognizing those gains is to some extent is a management decision, because anytime they can decide to dispose certain parts of the portfolio and take the capital gains to their P&L. That kind of a leverage may not be available, because if AFS portfolios gains and losses will not be recycled to the P&L account. Which means that the companies would need to think whether they still want to carry the investments under the AFS portfolio, or they want to exercise a choice of fair value through P&L option, which means that all gain and losses to the P&L account. But in that case, they will have to take that risk that in case of the losses, those losses have also have to be taken through the P&L account. There may be some tax implications as well, because I don't know how those gain and losses will be taxed, which are never cycled through the P&L. But obviously that is a tax regime which may evolve to when this accounting model will come into action, and therefore there will be a question that how those investment gains will be taxed if they are not routed through the P&L account. So on the equity side, that is the model which effectively will be followed. On the debt side, we classify debt into two categories. One, the debt instruments based on their characteristics, based on the way the cash flows from the debt instruments are derived. So one category of debt instruments are very simple debt instrument, which is plain vanilla debt instrument, which just provide lender a return in terms of the principal and interest. So those are called simple debt instruments, where the return is only principal and interest. And when I say interest, interest means something which provides you a time value of money and a return from the credit risk and the administration cost that which is involved. So anything which is received in return other than those components, which is not a time value of money, which is not a return for the credit risk that you have undertaken, perhaps is not an interest but something else. For example, There are certain instruments, more complex instruments, where the return is not linked to the time value of money, but it is linked to some commodity prices, gold prices. So you have a debt instrument which provides you return based on commodity price or a gold price, or sometimes in an inverse relationship, there is a of the interest. If the market interest rate is going up, the instrument will provide you a reverse return. And it's those kinds of instruments internationally are very popular in the insurance industry, because insurance industry wants to economically hedge itself by taking those instruments, because when the market is going in one direction, they want to go in the other direction because of the inherent risks that they have in the business. So those instruments which are not plain vanilla instruments, which are not simple debt instrument, will have to be fair valued through P&L account regardless of any other consideration. So sometimes we have convertible debt instruments where debts can be converted into equity. So there you have conversion options. Those conversion options are actually is providing you, so the return that you are receiving from those debt instruments also include a premium for the conversion option that you hold as an investor. So those are not simple debt instruments and therefore have to be fair valued. So let's look at the debt instruments which are simpler, which is majority the case. For those simple debt instruments, you have to look at the business model that you have for those instruments. Like a bank have debt instruments, and loan is also a debt instrument. So their business model is to collect all the contractual cash flows. So all the loans that the bank provide, the business model is not to sell those loans, but to collect all the underlying contractual cash flows. So your business model may be that you hold debt instruments, you have a TFC, PTC, or any bond, where you have a business model, you want to collect, you don't want to sell that instrument, but you collect all the contractual cash flows, something similar to held to maturity kind of a instrument. And that may happen, for example, if you have a long-term insurance liability, where you have committed to provide long-term annuity to the policy holder, and you want to match those cash outflows with investment in a bond which provide a similar kind of a cash flow to you, and therefore your business model is to collect all the contractual cash flows out of that bond to match your liability. So if that is your business model, then those instruments can be carried at amortized cost. If your business model is not to collect all the contractual cash flows, but is to collect and sell, which means you have a debt portfolio, you have investments, but you may sell them because you want to achieve a maximum return out of that portfolio. So you keep on, you're not trading in it on a daily basis, but for liquidity needs, in order to achieve a particular return from the portfolio, you can sell at a particular point in time when it meets your, as per your strategy. This business model we call collect and sell model, and I think most of the insurance companies may fall into that model, where the debt portfolios actually are held to collect cash flows as well, and in case of need, they can sell those investments to meet the liquidity requirements and also to maximize the returns. Those investments are similarly treated like we treat AFS investments, so all have to be fair valued, not lower of cost and market value, and gain and losses will be taken to the comprehensive income. So similar accounting treatment as for the AFS portfolio. And then the trading portfolios, so the debt instruments which are held for trading purposes, for frequent buying and selling, those have to be fair valued through P&L account. So there is a business model test which has to be applied before deciding the model, whether amortized cost, fair value through P&L or fair value through OCI, have to be taken for the particular portfolio. This is a decision which will not happen at a investment by investment level. Currently what we do, we take a decision on an instrument by instrument level, but a business model is not applied at an instrument level, is normally applied at a portfolio level. And insurance companies often analyze their portfolios again based on the fact that whether or not those portfolios are held to support a particular